Today, the High Wire Act continues. Market update for the 31st of July 2021. Hello again, it's Martin North from Digital Finance Analytics, where I made this post covering finance and problem news with a distinctively Australian flavour. Well, it's been another volatile week in the markets, with most close to highs, but also some wobbles, China in particular. Markets were whipsawed this week by China's tightening regulatory grip, a slew of earnings, and the outlook for stimulus. US equities actually retrenched at the tail end of the big earnings week, as investors worried about slowing growth at the mega-cap technology companies that have helped to drive the markets to record highs during the pandemic. Amazon dropped 7.6% in its biggest decline since May 2020, contributing the most to declines in the Nasdaq 100 and the S&P 500 indices after the company reported late on Thursday that revenue for the second quarter was shy of analysts' average estimates, and they said that sales growth would ease in the next few quarters as customers ventured more outside the home. So tech stocks, including Microsoft, also weighed down the Dow Jones Industrial Average. European equities dropped from a record, and Asian stocks slid amid China's regulatory clampdown. Overall earnings have been good, but Amazon and some of last year's winners are taking some of the air out of the market today, said Jake Dollarhide, the chief executive officer of Longbow Asset Management in Tulsa, Oklahoma. And this market has been driven by big tech, and when tech does well, the market seems to do right along with it. And when it doesn't, it falls. Data on Friday also showed that US consumer spending rose more than expected in June, although annual inflation accelerated further above the Federal Reserve's 2% target. As Wall Street put it, some stimulus checks are still straggling into bank accounts, and the extra unemployment monies from the federal government are still flowing to claimants in about half the states, and that money is getting spent. But all this extra money is a lot less than it used to be, and some stock market gains are also getting spent as part of the wealth effect. And employers are having to raise wages to attract people back into the workforce, and wages have ticked up, and that money too is getting spent. People are making a heroic effort to spend, but red-hot inflation is eating it up. Benchmark 10-year US Treasury yields slowed down after their recent advances, and on the data front, the US GDP rose 6.5% quarter-on-quarter in the second quarter of 2021, according to the data released on Thursday. The growth was solid but lower than the 8.5% forecast, and the 6.3% growth recorded in the first quarter. The GDP price index grew better than expected, 6.1 quarter-on-quarter in the same period, however. Meanwhile, the number of initial jobless claims filed over the past week grew to 400,000, which is higher than the 380,000 claims in forecast prepared previously, and lower than the 424,000 claims filed during the previous week. Global stocks also rounded up a volatile week, with the Chinese clampdown sparking a sell-off in Hong Kong and China, but US Federal Reserve Chairman Jerome Powell's indication that asset tapering would only begin once the economic recovery from COVID-19 has made sufficient progress helped underpin broad market sentiment. Powell's comments came as the central bank handed down its latest policy decision last Wednesday. With US Federal Reserve Chairman Jerome Powell struggling to adequately define transitory during his press conference on July 28th, the market narrative has shifted from hawkish Fed to dovish Fed. And with the US dollar bearing the brunt of investors' wrath, the all-clear sign flashed in front of precious metals, at least briefly. However, with post-Fed rallies mainstays in the precious metals historical record, the recent euphoria has much more of a semblance than substance. Thus, while Powell's persistent patience elicits fears of financial repression, today's economic environment lacked many of the qualities that made the gambit viable in the past. Financial repression includes measures such as direct government financing. The Fed prints money and lends it directly to the US Treasury, interest rate caps, or yield curve control as it's called, and extensive oversight of commercial banks, things like reserve requirements, controlling the flow of credit, etc. In a nutshell, governments use the strategy to keep interest rates low and to ensure that they can finance their debt. And with the US federal debt at a percentage of GDP currently 128%, some argue that that's exactly what's happening now. In other words, they want to inflate their way out of the debt. But of course, they can't tell you that. The disappointing jobless claims numbers put some firepower behind Powell's comments, emphasising that we have a ways to go for the labour market to recover. The miss on GDP only puts a finer point in the fact that growth may be stalling, E-Trade Financial Manager Director of Investment Strategy Mike Lerngrat said. The Dow Jones Industrial Average fell 0.42% to 34,935. The S&P 500 lost 0.54% to 4,195, and the Nasdaq dropped 0.71% to 14,672. But for the month, the S&P 500 rose 2.3%, the Dow gained 1.3%, and the Nasdaq added 1.2%, while for the week, all of the major indices posted declines. In fact, the S&P 500 notched a sixth straight month of gains. We are in high wire territory, as I said at the top of the show. Strong earnings and the continued rebound in the US economy have helped to support stocks this month, but the rapid spread of the Delta variant of the coronavirus and rising inflation have become concerns, and the S&P 500 company results in the quarter overall have been much stronger than expected, with about 89% of the nearly 300 reports so far beating analysts' profit estimates. Earnings are now expected to have climbed 89.8% in the second quarter versus a forecast of 65.4% at the start of July. There are still some distant jitters, whispers about the Delta variant, about cases rising, and I think some underlying worries about a slowdown of the reopenings and possible reversals. And Robinhood helped propel a meme stock frenzy this year that sent share prices of small companies on a roller coaster ride. On Thursday, in its own initial public offering, it was much more subdued than expected. Shares in the stock trading startup opened trading at $38, the same price as its offering, but then fell as much as 11%. They ended the day down 8.4% at $34.82, valuing the company at $29 billion. And it showed that investors were skeptical of Robinhood's grand mission of upending Wall Street. Robinhood is a growth stock, and it has the potential to continue growing, but the market is saying this growth doesn't come without risk, said Josh White, a finance professor at Vanderbilt University. Robinhood's free stock trading service has helped create the conditions for wild gyrations in meme stocks, driven by investors hyping their trades on social media. The company's offering is among the largest in a frenzied year for public market debuts, although few others have had the profile and level of controversy, including service outages, fines, congressional hearings, protests, and memes, as Robinhood has done. But the tepid trading debut suggested that there may be limits to investors' euphoria for IPOs, even in a blockbuster year for them. There were 213 in the first 6 months of the year, more than in any full year for the past decade, according to research recently released. This week alone was set to have 25 companies going public in the US, making it the busiest in 2 decades. Instacart, a grocery delivery company, and Nextdoor, a social network, are among the others expected to go public this year. A first-day slump like Robinhood's is rare. On average, shares in IPOs in the US jumped 39% on their first day of trading this year, but they've since fallen by an average of 1.6%. The unpredictability of Robinhood's initial trading was exacerbated by an unusual move by the company, which has a mission to democratize finance. Robinhood decided to sell as much as 1/3 of its offering to retail traders via its own app. Most other companies that have gone public would have not done this or offered only a small amount of shares to retail investors. That offering could have suppressed early trading, since first-day stock price pops are often driven by demand from retail investors who were shut out of the IPO. Only around 20% of the offering was sold to retail customers, indicating less interest than expected. The US share market has enjoyed a powerful rally this year, with the S&P 500 up 17%, but we wonder whether the Robinhood IPO is the bell that tolls the market peak. Robinhood's lukewarm public debut raises questions for the Silicon Valley company after a rocky year. Early in the pandemic, as the stock markets crashed, Robinhood suffered outages at critical moments. As the year went on and the app became more popular, commentators raised questions about the level of risk that traders were taking, especially with highly leveraged options trades. Other aspects of Robinhood's app, including confetti explosions and lottery scratch-offs, have drawn comparisons to gambling. One young customer, Alex Kearns, killed himself last year after a misunderstanding over debt in his account. Robinhood has since settled with his family. And in January, stock traders banded together on social media to drive up the share price of meme stocks, including GameStop, the game retailer, and AMC Entertainment, a movie theatre chain. Robinhood had to halt some trades and raise rounds of emergency funding to cover the collateral needed for its customers' trades. Telev's cell phone was seized by authorities as part of an investigation into the situation, and Robinhood was sued more than 50 times, and Tenev was summoned to testify in Congress. In June, Robinhood paid $70 million in terms of a fine to the Financial Industry Regulatory Authority for misleading customers and harming them with outages. And the controversies did not seem to hurt Robinhood's growth. The company added nearly 10 million customers over the past year, bringing its expected total at the end of June to 22.5 million. It has more than quadrupled its revenue to around $420 million in the first 3 months of the year, compared with $96 million a year ago, and it also posted a loss of $1.4 billion, which it attributed to the emergency debt that it had raised as a result of the GameStop trading in January. Buffett said the stock trading platform that allowed people to buy and sell stocks for free, such as Robinhood, are only encouraging inexperienced investors to gamble. Maybe it's not a $32 billion stock. Rather than charge a commission on each trade like traditional brokerages, Robinhood sold its customers' orders to Wall Street firms for a small fee per trade. Eventually, many of Robinhood's traditional competitors lowered their trading fees to zero. And the company expanded into other areas. It allows people to trade cryptocurrencies, including the joke currency Dogecoin, which accounted for 1/3 of its revenue from crypto trading in the first quarter. And it expanded into checking and saving accounts, though that launch was an embarrassment after it claimed the product was backed by a consumer protection group that does not insure such offerings. And more recently, Robinhood expanded into IPO offerings, including its own. It also said it would soon introduce retirement savings accounts. Along the way, Robinhood attracted more than $2 billion in venture funding. Its largest investors include New Enterprise Associates and Index Ventures. Scott Sandell, an investor at New Enterprise Associates who sits on Robinhood's board, said the IPO had created needed transparency about Robinhood business. There has been so much speculation about the company, and much of it is completely false, he said. Now that Robinhood is public, it's all there for everyone to see. In its offering prospectus, Robinhood said the founders, Tenev and Vant, together would own 16% of Robinhood's shares after the IPO, making their combined stake in the company worth nearly $5 billion. They own a very special class of super voting shares, though, that give them 65% of the voting powers over the company. With stocks trading near record highs and valuations stretched, some investors are increasingly concerned that the corporate earnings recovery is peaking as the market faces risks ranging from inflation to the fast-spreading COVID-19 Delta variant and China's crackdown on private technology firms. When you get to the valuation levels we're at, professional investors are looking for a reason to sell, said David Spiker, president of Guidestone Capital Management, which is about $18 billion of assets under management. It could be the Delta variant, it could be China, it doesn't really matter. They're looking for a reason to sell because they know valuations are extended and they don't want to be the last one holding the bag. Investors piled into cash and equities in the past week, according to a Bank of America note citing global data. Bank of America strategists recommended owning defensive and quality names in the second half of the year as policy flip-flops will end in a market correction, they said. Elsewhere, oil prices rose, with West Texas Intermediate settling at $73.95 a barrel as concerns about the Delta variant's impact on fuel demand eased amid tight global supplies. But the spot price for iron ore tumbled on Friday to $181.57 a tonne, which may signal the end of the recent boom in prices. The volatility index was up 3.05% to 1824, and gold futures settled down lower on Friday, but had climbed over the month. Renewed signs that the Federal Reserve may not taper anytime soon continue to sweeten appetite for the precious metal, while negative COVID-19 developments may boost attraction towards safe haven assets, said Luke Montaga, manager market analyst at FXTM. Looking ahead, however, gold may face multiple headwinds as the Fed finds it increasingly difficult to defend its dovish stance, he said. With annual inflation in the US already at a 13-year high and the economy recovering, hawks are bound to enter the scene, and such a development could throw a proverbial wrench in the works for gold bulls, sending prices tumbling lower. Gold futures for August delivery was down 1.07% to 1,811. And the euro-US dollar was down 0.2% to 1.1862, and the US dollar index futures was up 0.29% to 92.14. Bitcoin roared back this week to 41,391 as I write this, on, well, not much at all really, and will likely remain volatile in the weeks and months ahead. I still struggle as to how to value this digital asset. It's certainly not behaving like digital gold. And of course, much of the action is the relationship with the futures on Bitcoin, as many holders stake their coins to make a return while others speculate. Over in Europe, markets were weaker on Friday, again reflecting the change in sentiment in China, a deluge in earnings from some of the region's big names, as well as important growth data. In London, the FTSE was down 0.65% to 7,032, while the German DAX was down 0.61% to 15,544. Corporate earnings continued to take centre stage in Europe, with BNP Paribas reporting a 26% rise in net income in the second quarter, allowing the French bank to pay an additional dividend. And UK bank NatWest Group also used its newly regained freedom to pay a dividend and announced a £750 million buyback programme. However, this wasn't enough to interest investors on Friday, with both stocks trading lower. Two banks that stood out were in Italy, where UniCredit said that it had agreed the outline of a deal to buy parts of the country's long-running problem bank, Banca Monte dei Paschi di Siena. UniCredit stock rose by over 5% after saying that it has agreed with BMPS's current owner, the Italian government, that any deal should be capital neutral for UniCredit and not expose it to legacy risks at the scandal-plagued bank. And elsewhere, Renault stocks rose 3.2% after the French carmaker posted a net half-year profit, a sharp improvement from this time last year, and said it expected to post a full-year 2021 profit despite a worsening semiconductor chip shortage and rising raw material costs. Where have we heard that before? Air France KLM stocks rose 1.4% after reporting a hefty jump in second quarter revenue, with its net loss narrowing, outperforming British Airways owner IAG, whose stock fell 2.7% after it predicted a cautious summer recovery, saying capacity would rise to 45% of pre-pandemic levels from 22% in the previous quarter. In economic news, French gross domestic product rose 0.9% in the 3 months ending in June, an improvement from the drop of 0.1% the previous quarter, while Spanish GDP soared 2.8% in the quarter, up from minus 0.4% last quarter. In Asia, equity markets fell mostly on Friday, with North Asian markets leading the charge lower. This is, of course, in strong contrast to North America, where strong earnings and benign inflation expectations saw the leading indices rise once again to record highs. Risks from China's crackdown on industries, including private education, at the beginning of the week also remain. The North Asia to ASEAN divergence is actually quite intriguing. The fact that tech-heavy Nasdaq futures have led US index futures lower suggests that they and China, Japan and South Korean markets are suffering a dose of, well, pre-weekend China regulatory risk jitters. Notably, there is likely to be a lot of COVID bad news priced into ASEAN markets, with Delta variant nerves rising in North Asia. The combined China and Delta risk may be causing some rotation into ASEAN markets as a defensive position. A strong market rally by the Sensex in India suggests that investors are rotating out of China but unwilling to leave the Asian story behind, so they're looking for pastures new in other parts of the region. Going forward, depending on how the regulatory risk landscape evolves vis-à-vis China, ASEAN and Indian equity markets may find more friends from the international investor community than they have of late. The composite index there increased 4%, or $344 this week, and also remains 368% higher than a year ago. The Nikkei 225 slumped by 1.8% on Friday to 27,283, and jobs data released earlier in the day for Japan said that the job applications ratio for June was higher than expected at 1.13, while the unemployment rate was lower than expected at 2.9%. However, retail sales plunged to 0.1% year over year. In China, the Shanghai Composite slid 0.42% to 3,397. Now, inflation, I think, still lurks, judging by the WCI Jury's Composite World Container Index, which increased by 4% or $344 this week to reach $9,330 per 40-foot container, which is 368% higher than the same week in 2020. Freight rates from Shanghai to New York soared 13% to $13,434. That's a change of 300% year over year. Spot rates on Shanghai to Los Angeles increased 6% to $10,503, and rates on Rotterdam to New York grew 5%. Freight rates on Shanghai to Genoa and New York to Rotterdam, though, remained stable at previous week's levels, but Drury expects rates to increase further in the coming weeks. Now coming back to Australia, Australian shares closed little change this week despite hitting a record high earlier in the week, as the markets drifted lower in the last few trading sessions of the month. In Australia, the ASX 200 inched down 0.33% on Friday to 7,392 and dipped 1.8 points or 0.02% over the week. The country's producer price index grew 2.2% year on year and 0.7% quarter on quarter in the second half of 2021. Private sector credit grew 0.9% month over month in June, and this last week brought the first few results of the earnings season as the Sydney lockdown was extended by an additional month. The escalating lockdown in New South Wales and now a further snap reaction in other states comes at a time when cost pressures are rising and crisis assistance is more piecemeal in nature, said Morgan Stanley equity analyst Chris Nichol. A new backstory could be required when selling the next outlook statement, making the results season possibly more volatile, and domestic outlook will of course be the focus. The major banks were mixed during the week. Commonwealth Bank advanced 0.5% to 99.65, while Westpac fell 0.8% to 24.52. ANZ edged up 0.1% to 27.71 and NAB declined 0.4% to 25.93. ANZ and NAB have recently announced on-market buybacks. ANZ at 1.5 billion, which is around 2% of the share count, and that'll take 35 basis points off the CT1 and increase the ROE by around 30 basis points. And NAB is buying back $2.5 billion of shares, which is around 3% of the share count, with 60 basis points off its CT1 and plus 40 basis points, increasing in ROE. And we can expect more of this from the majors. And in contrast, by the way, Macquarie this week lowered its dividend payment ratio to 50 to 70% from 60 to 80% to deploy capital into a raft of opportunities. Fortescue Metal Group dipped 1.3% to 24.91, despite delivering record export volumes for the past 3 months and the past year, making the most of soaring iron ore prices, which, as I highlighted earlier, seem to be going into reverse now. Crown Resorts tumbled 40.1% to 861 this week. It paid the Victorian government $61 million in taxes and penalties after evading the state's gambling tax for 9 years. It may have to pay as much as $480 million, according to counsel assisting the Victorian Royal Commission. Tech stocks were hit hard during the week. Appen declined 11.1% to 11.36. Nuix fell 11.7% to 2.48. Afterpay slid 9.4% to 96.66. EML Payments dropped 6.8% to 3.44, and Zipco declined 6.3% to 6.64. The big miners dominated the gains this week after Rio Tinto announced its biggest 6-month profit on record and also declared a monster $5.61 per share dividend. Easily the miners' biggest interim payout ever. Its shares closed the week 5% higher at 133.42. This result supported gains in the other iron ore miners, with BHP Group adding 4.3% to 53.49, Mineral Resources up 2% to 63.01, and Champion Iron firmed 12.4% to 7.60. The smaller miners were also among the market's best performers, with Lynas Rare Earths adding 14.2% to 7.34, and Oz Minerals firming 9.3% to 23.18. Irish shares climbed 9.3% to 14.05 after getting a takeover offer from private equity firm EQT. While Iris rejected the bid, it has allowed the company to access its financials, and talks remain ongoing. So in summary, this is a bumpy old week. We're walking the high wire, but there are still lots of concerns. I'm not sure the safety net looks particularly strong at the moment. We'll keep watching. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.